Listen carefully. January 20th, 2026, a number that was ignored but shouldn't have been. Japan's 40-year government bond yield broke above 4%. Precisely 4.24%. It sounds small, but it's not a detail, it's a signal. Here's what most people didn't see. In the weeks that followed, data from Japan's Ministry of Finance confirmed something critical. Japanese investors sold a net $20 billion in long-term U.S. Treasuries in just 2 reporting periods ending April 11, 2025. That's not rebalancing. That's a shift in capital flows. At the same time, giants like Daiichi Life Holdings and Nippon Life are sitting on roughly $60 billion in unrealized losses on their domestic bond portfolios. Understand this. They're not just losing money, they're losing the reason to keep holding. And here's the core of it. According to the latest data, Japan is still the largest foreign holder of U.S. debt, with nearly $1.2 trillion in treasuries. $1.2 trillion in the hands of institutions that are beginning to have a reason to come home. This isn't news. This is the beginning of a move the market hasn't priced in yet. Pause for a second. Before we go deeper, understand this clearly. What you're about to hear is not opinion. This is analysis based on public data you can verify. This is not financial advice. This is pattern recognition, and you will have to make your own decision. Because the question this video raises is not just accurate, it's uncomfortable. If a country that built its entire post-war financial system on recycling dollars into U.S. debt suddenly realizes that the math no longer works, then what happens? What happens to interest rates, the very thing that prices every asset you own? To understand what's happening in the Asian bond market right now, you need a framework. Not theory, not textbooks, but a 4-stage sequence drawn directly from data and repeated over and over again. And once you see it, you won't be able to unsee it. Whether it was 2022, 2025, or right now, spring 2026, the pattern doesn't change. It always begins with anchor drag. This is the moment a major holder of U.S. debt no longer wants to hold as much as before. Not because of politics, not because of headlines, but because the math inside their own domestic market has changed. It happens quietly. Accumulation slows, and only then does selling begin. Like a ship, the anchor was lifted long ago. You just don't notice until it's already drifting. Then comes phase 2, yield spread compression. For 30 years, capital flowed into the U.S. because yields were higher. But when Japanese yields surged after 2024, the math flipped. No panic, just recalculation. Phase 3, capital repatriation. Not a fire sale, but risk models start saying the trade is no longer worth it, and money begins to come home. Finally, phase 4, risk premium reset. The world starts demanding higher yields to hold U.S. debt. A near 5% 30-year yield in March 2026 is not random. That's the market asking to be paid more. The country may change. The timing may differ. But the mechanism always repeats. This detail was always there, just ignored. When central banks like Germany and Japan begin worrying about inflation and signal domestic rate hikes, the market calls it one thing: volatility. In 1987, before Black Monday, it wasn't equities, it was the bond market that started shaking first. The Federal Reserve had to step in, just to keep the system functioning. The lesson is clear: when foreign markets tighten, U.S. yields don't wait. In 2022, the United Kingdom repeated the same mechanism. A policy mistake triggered margin calls. Selling led to more selling. The Bank of England was forced to step in with a £65 billion intervention. The data was there. No one looked. Now, Japan is in a similar position, holding massive amounts of long-duration bonds while domestic yields are rising. This is not a hypothetical risk. This is a mechanism. And China, from a peak of $1.3 trillion in 2013, down to around $683 billion by 2025. Not volatility, but restructuring. Gold up. U.S. Treasuries down, and when the largest buyer becomes a seller, it doesn't happen instantly. It builds. Until one morning the market wakes up and everything is different. This is where the model becomes real. Japan, the largest foreign holder of U.S. debt, holds around $1.2 trillion. For 30 years, that made sense. Domestic rates were near zero, while U.S. Treasuries paid more. But that structure has broken. By late 2025, the Bank of Japan began raising rates. By early 2026, 30-year yields moved above 2.5%. 40-year bonds crossed 4% for the first time in over 3 decades. This isn't volatility. This is structural change. The media calls it a domestic story, stimulus, debt issuance. That's not wrong, but it's not complete. The truth is, the yield differential had already collapsed. According to JP Chase, repatriation flows began as early as the first half of 2025, and once it starts, it doesn't stop. Japanese insurers like Dai-ichi Life Holdings and Nippon Life are sitting on roughly $60 billion in unrealized losses. Yields rise, bond prices fall, capital pressure builds. The response is simple: sell the most liquid assets, and that means U.S. Treasuries. In December 2025 alone, over $5.2 billion in long-term treasuries were sold. 1 month, a record level. Now look at the result. U.S. 30-year yields approached 5% by March 2026. Not because the Federal Reserve changed policy, but because the market is demanding to be paid more. This is no longer about policy. This is demand reshaping the entire system. There are moments when the market sends a signal, and 2025 was one of them. According to Michael Cembalist at JP Chase, the combination of U.S. equities falling, the dollar weakening, and bond yields rising at the same time has only happened 13 times since 1970. The last time? 1981. That's not noise. That's a signal of a U.S. sell-off. And by March 2026, that pattern hasn't disappeared. It paused, and then continued. But here's the part most people miss. Foreign investors don't just hold U.S. Treasuries. They hold around $18.5 trillion in U.S. equities, compared to roughly $7.2 trillion in bonds. If capital starts to leave, the bigger risk sits in equities. Understand this. China doesn't need to dump assets to create pressure. They only need to do one thing: stop buying. For over a decade, they've been steadily reducing U.S. Treasuries, while accumulating hundreds of tons of gold. This isn't trading, this is repositioning, and when marginal buyers like Japan and China reduce demand, even slowly, the market is forced to do one thing: raise yields to find new buyers. A near 5% 30-year yield. That's not abnormal. That's the answer. $30 trillion in debt, and still, no real alternative. Not Europe. Not Japan. Not any emerging alliance. When global capital needs a large-scale safe haven, there's only one destination: U.S. Treasuries. And the data confirms it. According to the United States Department of the Treasury, foreign holdings peaked at $9.05 trillion in March 2025. Not an exodus, a record. The Wall Street Journal even cited strategists arguing that the U.S. sell-off was just a one-week event, followed by renewed buying. It sounds reasonable, but here's what gets missed. Japan isn't just an investor, it's an ally. Selling U.S. Treasuries isn't just financial, it's geopolitical. That's why experts at State Street Global Advisors argue the risk of a mass sell-off is low, and that's true when domestic yields are near zero, but not anymore. When Japan's 40-year bonds hit 4.24% and domestic institutions are sitting on billions in losses, math starts to override geopolitics, and that's where everything changes. Geopolitics cannot override math. Alliances can hold on paper, but balance sheets don't care about loyalty. When Japan's 10-year yield hit 2.38%, the highest since 1999, capital began to reverse. Not because of politics, because of math. And when you apply that pressure to a $1.2 trillion portfolio, the outcome becomes inevitable. This isn't a collapse. This is repricing. Not a shock, but a slow, persistent process where long-term U.S. yields grind higher as demand from Asia weakens. Around 5% for the 30-year Treasury. Not a ceiling, it may become the floor, and this doesn't play out in a single quarter. It unfolds over 2 to 4 years. The data points to 4 things. Long-term yields will stay elevated. Geopolitical risk is being underpriced. Treasury auctions will reveal the truth about demand, and the Bank of Japan is the most critical variable. Every time Japan raises rates, U.S. Treasuries become less attractive. This is one of only 13 rare periods since 1970 when equities, bonds, and the dollar weaken together. Not a catastrophe, but a prolonged adjustment reshaping the entire system. What you're looking at isn't just bonds, it's your mortgage rate, it's corporate borrowing costs, it's pension fund returns, and the entire asset pricing system. If you're building a financial plan for the next 3 to 5 years, the data does not support a return to 2021 interest rate levels. It points to something else. A world where U.S. yields stay higher. And here's the question you can't avoid. What happens when a country that spent 3 decades recycling dollars into U.S. debt decides that the math no longer works? The answer is simple and uncomfortable. Everything that was priced on that assumption gets repriced until the market finds a new equilibrium. And that process is already underway, not in textbooks, but in the data, in the Asian bond market, every Sunday night. If you're starting to ask questions, good, that's where it begins.